Good morning. Now what do I do? Can you not hear me?
Morning, Tracy.
Oh, hi. Good morning, Tom. Can you hear me?
I can, yeah.
Okay, good.
Hopefully this won't be painful.
No. Hello? Morning. Good, how are you? Yeah, I'm logged in. Tom's logged in. Yes, please. Sure. Oh, look. Oh, yeah, that's a mistake. One should be transmission plant, one should be distribution plant. Just don't do a typo, we'll fix it. What you say? Is it a pension? I just wanted to. I think this would be one, we have to also take like a $418,000 the contributions made in the future. See down the right line of the page. Okay, thanks. Yeah, yeah. All right, bye.
You're on mute. Okay, yeah, bye.
Good morning.
Morning.
There we are.
Can you?
We all up with the birds this morning?
Yep.
You hear me okay, Tom?
We're okay.
There we go.
We're
Good
still
morning.
live. Morning.
Still dark here where I am.
Hey, good morning, everybody.
Good morning.
Good morning.
We
Morning,
got a
Jack.
couple minutes. We have a couple minutes before we're official, so wait a minute. I'm running a little bit late this morning myself. Needless to say, Tom, I won't be joining you.
Yeah, that's all right. We got we put it on the phone mic, so I don't know if the sound is better or not, but.
Yeah, it's okay. I don't, it's not fabulous, but it's all right.
Better.
Could be just me, Jack, you know?
No,
Yeah.
it's not. You sound much better when you're sitting in front of your computer. I mean, we could look into, a nice omnidirectional mic, a nice one. So if we're going to be doing this, when we come back to in-person meetings, and have the hybrid option, I think it would be nice for people to easily be able to hear what we're saying.
Yeah.
Yeah.
Because I have these, I have it on the conference line. So I figured that would be better with the mics are right in front of us.
It is better.
Oh, it is, okay.
Yeah. One thing to be aware of is that now that the mic's on the phone, all the noise of papers going back and forth on the table. If that happens
Really?
while you're talking, it's just, I don't know how that will work.
Well, I guess we're past the magic hour here, so we can get started. So today is the what is the date today? Today's the 8th of, I'm sorry, the 4th of November. And it's 7:30 in the morning. This is the Hingham Municipal Light Department and a regular board meeting. So the first order is to consider accepting the minutes that we have of September 28th. Anybody got any comments?
Let me, think I did not, so. I think I'm all set.
All set? So
Yeah.
could we have a motion then to accept them?
So moved.
Second, any comments? If not, all in favor?
Aye.
Aye. All right, they're accepted. So do we have the, what do you want to do next, Tom? You want to do the,
We have Tracy and Jim here to do
financials?
Yep, 2020 audited financials.
Yeah. So does someone want to take the lead and walk us through?
Well, good morning. I'd be glad to do that. I'm Jim Goulet, managing partner of Goulet Video. I have with me Tracy Vaughn, who's the lead auditor on your account, and I'm happy to present your 2020 audit with numbers, comparative numbers to 2019. So the best news, the good news is that in the audit report, which is in the beginning of the report, you have a nice clean opinion. There were no issues that would be of concern as far as the audit goes. Believe it or not, there are some issues with pensions these days that do create a qualified opinion. Your system does not have those issues, so that's good. It's a clean opinion. The next section, beginning on page 3 of the report, is a management discussion analysis. So that's management. That's the Hingham Light Board and the management discussion about what's important, what's really relevant to what's going on in the light department. While we don't actually audit that, we do review it, make sure the numbers all coincide with the audit report. So I won't spend a lot of time on that, but it's more narrative in nature. I always say to the board, I said, if someone has questions about what you're doing, just refer them to the MD&A. That's kind of a great analysis of what's going on here at the department in a snapshot. But our audit begins on the statement of net position on page 7.
Would you like questions as we go along?
As you go along would be great, sure.
Okay, so this is my first time through these this, so I may have more questions. I hope I have more questions this time than I will next time. The summary of net position, I'm not familiar with that term, but looking at it, it looks like it's basically what you would call equity in a for-profit entity. Is that
That's correct,
right? Okay.
Yes. Assets minus liabilities is equity, and
Okay.
in the government net light department context, it's called net position is the term they use.
Okay, thanks.
And just for further clarification, it's broken down into the various areas where it's either unrestricted or possibly restricted for certain designated uses.
Mhm.
Okay, that's why there's 3 categories here. And we'll come back to that. There's more discussion about that coming up. So on page 7 is the, and I presume you all have the financial statements that you're following along with, right? Okay, page 7 is the statement of net position.
So let me just say, if I do have questions about the MD&A, should I just ask Tom later, since this is the light plans, the general manager's presentation?
Yes, they drafted it, so they had a large input in what was written in it, yes.
Is that appropriate to do now, or Jack, or later?
I think now is a good time to answer any questions, sure.
Okay, so I see 15 million net position restricted for depreciation on page 4, and and then 6.6 million unrestricted net position. But does that include the rate stabilization? Which of those numbers includes the rate stabilization fund?
So the rate stabilization fund will be in, it's a designated fund, it's really unrestricted. So that would be in the net position. That really wouldn't have any bearing because you have an asset for the rate stabilization, the money that's set aside, but there's also a deferred liability in it, an inflow. So that is actually nets out to 0. Okay.
So whatever the amount of money there is in your rate stabilization fund, you assume a liability for it
Correct.
because it's expected to go out.
Mm-hmm. Yeah, I think if we go through the statements first, I'm not trying to rush or avoid your questions, but I think some of the questions might get answered because the MD&A is a snapshot. The financial statements we're going to go through are actually a little more detail. And I think it's going to answer questions like that.
Sure.
That's okay. Okay, so on page 7, back to the statement net position. So the net position is all the assets minus all the liabilities. So the current assets, and current being defined as assets that are used in the normal operating cycle of 1 year or less. So you have your cash on hand with the town treasurer, the operating fund, 8.2 million. Accounts receivable, net of an allowance for doubtful accounts of $50,000, 2.3 million. And on that allowance for doubtful accounts, it's interesting because of the COVID, what we've been through the last few years, that the receivables are still in pretty good shape. And we're seeing that really in the industry, that we would expect a lot of people to really fall behind. And while some have, it's really not having much of a financial impact from what we've seen on light departments. Accounts receivable related party. So we interact with the town. There's a footnote explains all that in the back. We owe them money, they owe us money for services rendered each way. Other receivable, we'll see a schedule to detail that, but that's things like jobbing income, erects receivable, things like that. Materials and supplies, that's the inventory of all the poles, towers, transformers, streetlights, all the assets that are in the shop that have not yet been placed in service. So it's still an inventory account. Prepaid power contracts.
Quick question on that.
Sure.
Does that include vehicles?
No,
Okay.
no, vehicles are under plant because they're long-term assets.
Okay.
Yep.
Short-term.
Prepaid power contracts are money held with our power supply agent, Energy New England. So that when our bills come due, our power bills from the various agencies, they have the funds to pay them.
Is that invested? Because later on I saw some income related to the prepaid power. No, that was the power purchase reserve, actually. Maybe we'll talk about that when we get there.
Yeah, so that I think
purchase power working capital, that's what I'm asking about.
Right.
There was some income from that.
That is also money held at E&E, Tracy, is that correct?
Yes.
Okay. So I don't believe that's invested. That's just
No, it's in a money market account. You do get income on it, but it's not invested in assets.
Okay, thank you.
So total current assets up from 13.4 million to 15.4 million. Non-current assets, there's your depreciation fund. And these are all accounts held with the town treasurer. These are cash accounts. The depreciation fund, 15.7 million. Customer deposit account, 1.7 million. There's an insurance reserve that's been on the books for a long time, hasn't been used lately. And a rate stabilization fund, that's the other side of the rate stabilization cash account. I'm sorry, that's the cash account, almost 7.5 million that's been set aside to stabilize the rates. Investments, 362.
If I may, a lot of my questions have to do with understanding how the depreciation fund works and the rate stabilization fund. Rate stabilization fund went up by 1.3 million over the last year, and I think that that is the 1.3 million that we assigned to what is called in the MD&A the green rate stabilization fund, and that's the arbitrage from sale of RECs and purchase of other RECs.
Yes, correct.
And so I'm just confused. I'm confused by putting that 1.3 million in the stabilization fund. I realized we wanted to set it apart for use, but the planned use is, as I understand it, did not have to do with rate stabilization. Rate stabilization, I assume, is there to avoid an impact on ratepayers when there is a sudden rate change that they might find hard to accommodate. But that's not the purpose for which the 1.3 million was set aside. So I'm wondering what's the reasoning for having it in that fund.
I think the presentation may be a little bit different next year because that money actually wasn't transferred until 2021. And I believe that the green power is going to be a sub account. JC, is that correct? On the books, the actual books records?
As I remember, the one, Joan?
We do have two separate accounts in our general ledger that is combined for financial statement presentation purposes.
Right.
Right. I'm just questioning calling it rate stabilization. It feels somewhat misleading to me.
Well, we can change that for next year, Tracy. How do you feel about that?
We can, but I thought the whole purpose of selling the RECs to save the money was to do green power stuff. So in essence, you are reserving a certain amount of cash for a specific increase or power cost or to deferred power cost in the future, which is why we set up a matching corresponding liability as well. But I do believe that the cash that we were talking about, the 1.3 million, didn't get transferred to 2021. So that piece is still remaining in operating cash. And where this cash, I believe, had to be a different transfer to the rate stabilization fund. Joan, don't you do regular transfers to your rate stabilization fund anyway?
Yeah, we were putting in 50,000 a month at one point in time.
So it just happened to come out to the
Yeah,
number that
it
looked
just
like
happened to be the
okay.
same amount, right?
Oh, okay.
Plus,
All
it
right.
earns pretty good interest and dividend, rate of return on it, also the whole investment.
Right.
Okay.
So that I think the issue with the green power, that's going to be probably presented differently. Again, it was a timing difference where it happened. It was voted on in the 20, but not transferred. So the presentation may look quite different. And I think if you want to show it as certainly an account that's reserved for a specific purpose, it can have its own account number. An account. It is on the books, but on the financial statements, if you want to illustrate that, we could separate that next year.
I think that would be clearer.
Mm-hmm.
That would be good. I mean, obviously.
So again, just under the same section where funds on deposit with treasurer, I would put rate stabilization - green fund. Is that what you're requesting?
Well, yes, I'm requesting it be, is a rate stabilization fund a fund that we're allowed to establish? And that's why we're calling this a rate stabilization fund? Are we not allowed to establish other funds? I mean, this has to do also with the amount of money that we can retain under mass law.
I believe you're allowed to create the fund, it just has to be at the will of the treasurer to control it. So I believe you can have as many accounts as you want.
Okay, so it would be perfectly all right to just, I mean, to me, it's not for rate stabilization, it's for green initiatives.
Okay.
That's,
But a rate stabilization is loosely defined and can be used for multiple things. We have clients that borrow money from their own rate stabilization fund instead of going to bonding for a short periods of time to do specific projects. Or if they
Right.
had to come into a large amount for an OPEB payment, they would pay their OPEB payment and then reimburse themselves. So the account as itself being rate stabilization isn't always just used for power costs.
I understand that, but presumably both of those two instances that you just described, it's a situation where if they didn't borrow from the rate stabilization fund, it would affect rates. You would have to raise your rates to cover those, the bonding or whatever. And
Agreed.
that's why it's rate stabilization. But in this case, it's funds set aside for voluntary
Specific.
expenditures on projects that we don't have to do.
Right.
And it would not affect the rates if we.
Well,
Because
it-
we're going to use these funds for it, but not other funds.
so in that instance, though, the way the account has been set up, it has a corresponding liability. So when you do use the funds, if you use it in a manner that it is a capital expense, where it's like you buy solar panels or electric vehicle stations, when I relieve the liability, that's going to show as revenue at that time. Because this year we took the expense to recreate the liability. So
Mhm.
this year you have a large expense of 1.3 million, even though the cash didn't get moved. In the future, when you do use these funds, depending on the nature of the expense, it could show as revenue.
Examples you use, Tracy, would be fixed assets, that'd be planned.
Yeah,
Not-
if it's a
not an
capital
expense.
item. Right.
It's just fine, you can use it for that, that's fine.
Okay.
If
and
you
that's-
end up
yeah.
buying it, if you were to buy a power contract that's related to a green initiative, or another wind tower or another solar, and you're in a power contract, when you pay for that contract, you could use these funds to pay for that contract, and then it would be revenue neutral. The liability would be relieved. You have an expense and the liability would be offsetting that.
Mhm.
So
Okay,
depending on what you use this cash for, it could affect your income in years that it's a capital expenditure.
okay, so that's of interest because I keep coming back to this fact that we're only allowed to earn a certain percentage.
8%.
and It might have an impact there.
Mhm.
Okay,
Mhm.
thanks.
Okay, so we're down to the last item of the non-current assets is the net utility plant. There's a detailed schedule that we'll get to. But that's the net, that's the gross cost of plant over the years you've been in business minus the depreciation taken over the years. So non-current assets, 52 million, total 67 million of total assets. Then you have your deferred outflows of resources, you'll see on the.
I'm sorry, we went right by investments and I just wanted to ask,
Oh, I'm sorry.
are all the funds that we have that get investment income, are they invested all through the town treasurer?
The only money that you have that's invested is your OPEB trust.
And that's
This
part of
investment
the
here-
towns? Is that part of, well, we'll get to OPEB.
No, you're not. You are in the OPEB trust of the town, but you do have your own investment policy.
Okay. Thank you.
So the investments in this account that I missed, the 362, that's your investment primarily in the Energy New England, your partner in that entity.
Yeah, this isn't like mutual type investments. These are other types of investments.
I see. Okay, thank you.
So the deferred outflows of resources generally relate to OPEB and pensions. Those are just timing differences that have occurred or differences in estimates when they get trued up. And those estimates get amortized over 5 years. The schedules in the back and the footnotes that explain that. So that's just all related to timing differences. Page 8 is the liability side of the balance sheet. Accounts payable, 1.5 million. Generally, that's your December power bills that you pay in January. Accounts payable related party, that's the other side of the town, Interactive. We reimburse them for things like health insurance and payroll related costs. Accrued expenses, 122, that's just probably vacation pay, things like that, the general accruals. Customer advances for construction, 29,000. That's, we have a developer working in town. They put money up to provide the infrastructure that ultimately becomes the property of the town. Sales tax payable, your commercial customers are assessed to sales tax. That's state tax rates, and that's the amount for December that paid in January. So current liability is pretty consistent, 2.2 million, down from 2.4 million. Non-current liabilities, customer deposits, Since those are held for the long term, they're really considered non-current. And then generally the cash account side of that is the identical amount of money, 1.7 million. The net pension liability is 3.5 million. Remember that this has only been the last several years where the pension liability actually had to be brought on the books, based on the actuarial studies are done. So this was a pretty big hit to many departments. Unrestricted net position, a liability just didn't exist all of a sudden. It came on the books, and it wasn't amortized, and it was brought in all in 1 year. So, but it's a true picture of how we stand. If we were to stop business today, we would still have a liability. Net other post-employment benefits, the OPEB obligation. This is net of the amount of money you have in the account. It's 1.3 million.
Oh, okay. That's what we actually have in the account.
The next page is, we have a trust fund for the OPEB. So the trust fund is on the next page is going to, well, coming after the operating financial statements, will show what's going on with the trust, the actual cash account.
Okay.
This is the net liability that still we haven't not funded yet.
Okay.
So total non-current liabilities almost identical to the year before. Total liabilities 8.8, just down slightly from 9.1 million.
So did the net pension liability come on in 2019? Is that when we were required to put it on the books?
No, it's
No.
been more. What was
It's
the
been
other
like
trade?
5 years.
Okay.
I think it's been 5 years.
Okay.
You'll be able to see the
flies.
schedule in the back.
Deferred inflows of resources. There we have again, these are all timing differences related to, in this case, contribution to construction. So I mentioned earlier, you may have a developer who's providing the cost of the infrastructure when he builds a new roadway or whatever. It could be substation improvements or transformers. So that's the amount of money that we're taking in, and that'll be amortized against our depreciation expense as we amortize or depreciate those assets. Then you get the pension and the OPEB, timing differences, and then there we keep the rate stabilization reserve. So again, the asset equals liability until it gets used. So net position is the capital assets is basically your depreciable assets. Your depreciation fund is the actual balance in the depreciation fund, because that's restricted. You cannot use that for other than what Chapter 64 allows you to use it for. There was a restructuring rule many years ago where that allowed you to use that for things other than actual plant. And there's a definition of that, but in the industry, typically that is really only used for new plant additions. That's the intended use, even though if you get into trouble, you can use it to pay a power bill, believe it or not.
We can use it for what?
A power bill or a contract, some contract, yeah.
Okay.
Unrestricted deposition, 6.6 million. That's the difference of all the other assets minus the liabilities. Okay, so 48.7 million. Again, I think 2020, even with COVID and everything, in the electric light industry, it was pretty consistent, pretty stable. No wild changes this year. Okay, so that brings us to page 9, the statement of revenues, expenses, and changes in that position. Sometimes called an income statement. This is basically a capitalized version. It's sale of electricity, 30 million, very consistent with last year, the previous year. Other operating revenues, 137, total 30.7 million of revenue. Expenses, operation and maintenance, 26 million. Depreciation, 3.2 million. And net total operating expenses, 29 million. Net income, 1.288, down from 3.8. So that reflects some of the transfers that were made. They're reflected in the expenses here. Investment income, 196,211, and interest expense. Interest expense, I believe, typically would be paid on customer deposit accounts. Net income before transfers, 1.4 million. And then you made a transfer to the town for payment of taxes, 474,613. So the net income minus those transfers brings us to our net position of 48.7 million, which is the amount on the balance sheet on that statement of net position. Okay. Statement of cash flows, beginning on page 10. So what this does is it basically breaks down on a cash basis the sources and uses of your cash accounts, where your money came from, what it was used for. So it doesn't really have much relevance to running light department. I always say it's the same in the banks, to say how you're managing your money. So if you look at what we do every day is we have our operations, we sell electricity, we purchase it and pay all our bills. That generated positive cash flow of 5.8 million. There was financing and non-capital and finance activities. That's at interest expense, $2,600. If you had some debt, for example, that might show up there, but you don't. Cash flow from capital and related financing activities. So non-capital was the interest. Capital, actually now we're going to purchase some plant fixed assets. So your transfers, your depreciation come into play here. Your actual additions of 1.5 million. And then contribution aided construction, the 447 is a negative to that. That's money received from our developers. So use of cash negative is $4 million. Then investing activities, we had a small amount of investment income, and then we transferred 450,000 to the rate stabilization fund. That's part of the increase in that balance. So net.
So so Joan just said we contribute $50,000 a month to rate stabilization fund. Did I get that right, Joan?
In 2020, we did.
Okay, thanks.
That's the 450, yes.
Okay.
Overall cash increased to $1.3 million. We began with 8.9 million. Now we have 10.3 million. On page 11, if you look down at the bottom of page 11, those are the accounts we call unrestricted cash, the operating fund, the customer deposit account, the insurance reserves. Those are accounts that are really truly unrestricted. That's a 10,307,000 that is the same as the previous page at the bottom. The top of page 11 is simply a breakdown of the first section back there, the operating account, the 5.8 million. It breaks down the net change in all balance sheet accounts. Not really relevant to discussion, but it's there for make sure the numbers all balance out. So page 12 brings us to a really almost a standalone financial report. We do incorporate it into the annual report of the Hingham Light Department, but is the OPEB fund, which is its own separate trust fund. It has cash 43,912, investments of 2.1 million for a total of 2.2 million. That's the statement. That's the snapshot at December 31st, 2020. The lower section of that report shows what happened for the calendar year 2020 and 2019. So we received investment income of 34,000. There was appreciation in the value of the assets. So we have unrealized gains. Some investments had not been sold yet we value them as of December 31st. So had we sold them, we would have $134,000 realized gain.
Hey, I'm sorry, you've lost me. We're on page 11?
No, I'm sorry, page
12.
12. I moved to page
Okay.
12. Sorry. This is the OPEB trust fund statement.
Okay.
Statement of fiduciary position.
Okay, thank you.
Okay.
So could you start over? I'm
Oh,
sorry.
sure. Yeah, it's very simple. It's very simple. So at the top is the cash account, so the assets of the fund, the cash and the investments, 2.2 million, up 46,000 last year. And then the lower section shows what happened during that 12-month period last year. We incurred investment income of 34, had appreciated assets of 134,541, and then the expenses to manage the fund with 3,473. That'd be investment fees. So net increase of 165 and ending with a $2,046,000 balance. Beginning in 2,046 from last year, add the 145, you get 2.2 million.
So
So there are no contributions being made to it, only investment income.
there are no contributions being made to the
There
OPEB
weren't
trust
this
fund?
year. Correct. The department did not make any additional contributions to increase the fund.
Oh, okay. Is that because we're in good shape? Is that what that means?
You're in pretty good shape. This is an expense that's going to be incurred somewhere down the road when everybody retires. So it's a great idea to try to pre-fund it. The problem with this is on the income statement side of things, for both pension and OPEB, you have to record the cost of the service provided, even though it's not paid out yet. So the income statement shows the cost of OPEB and the cost of pensions. without regards to how much we're funding. You know, we're limited in how much you can fund by state regulations on the pension side. So you can't, you couldn't go to the pension for Massachusetts. They wouldn't let you just go and put $6 million into the pension account and say, okay, we're fully funded. It doesn't work that way.
Okay.
As I
Why
understand.
not?
That's because
You think they would want that? I mean,
yeah, you would think so, but they're all, the problem is that the cities and towns can't fund that. Where light departments have a better ability to build it into the rates to fund it. But the problem with the light department side, where we're more of an enterprise fund, a business, if you will, is that we record those expenses. So if we record the expenses on a profit and loss statement and collecting the revenue to cover those expenses, so we're not showing a loss, then in a way we have that money in our hand. So we really should set it aside. So light departments have a better ability to set aside both OPEB and pension money. That's why certain trust funds are set up to do that. Okay, but there's no timeline. I know the state pension, the PERAC, they always try to say we're gonna be fully funded by 20 years from now. And that date just keeps moving out.
oh, really?
Yeah, as the economy needs to adjust.
Okay.
You'll see on page 28, when we get to the footnotes, that the OPEB happens to be about 61% funded already,
Oh, okay.
which isn't bad, which is a
No,
really
that's
good
pretty good.
amount.
What would you, I mean, do you have a metric of what you think is an appropriate investment? And if we got below a certain percentage, we should then make an investment, which we didn't do this year in OPEB?
No.
It's really discretionary in what the light department can afford. It's hard to say. Most of our departments are in the same range or higher than you guys are. We have a few that are fully funded, but then they actually change the assumptions and then you're overfunded. So it's really hard to get close to what you want to be because the actuary changes these things on a yearly basis with their assumptions.
Okay.
So I think you're in a great zone.
How often do we do an actuarial study to figure out what our liability is ultimately?
Every
anybody
other
know?
year,
Every
they
other
do a
year.
study, yeah.
Okay.
Every year they update the numbers, but they do the valuation every other year.
Okay. Thank you.
Okay, so that leads us to page 13 and the rest of most of the rest of the lengthy report. So we're talking about the footnotes that begin on page 13. Note 1 goes on quite a ways, and I always ask Tracy in note 1 of the accounting policies, were there any new accounting policies that we had to address this year?
No new policies, but what I would draw your attention to was on page 13, the increase in the depreciation. That's something that's discretionary by the town. And you'll see about the middle footnote where it says utility plant. If you read through the whole thing, it says that this year you chose to do 5%, which would have been a request you put into the DPU, opposed to the year before you do 3%. A lot of towns, including Hingham, do that when you have a large project on the horizon and you want to start putting your own money away, so you can start, instead of having to go to bonding or trying to ease the bonding ratio with your own cash, you increase your depreciation expense. That's the only thing on this page that I think has changed.
Okay, good point, because I did notice that the depreciation cash account went up quite a bit from last year.
Yep.
Yeah, it doubled.
You know, the
Even the
expense
expense doubled this year, yeah.
Yeah, okay. So the footnotes go up until page 15. Note 2, concentration of credit risk is just definitions of financial or types of risk that every entity takes.
I'm sorry, where are you?
Page 16, 15 goes on to 16, page note
Okay.
2.
I just, on page 14, I have a question, the pilot payment. And this may be a question for Tom or Joan, really. Is there a formula by which we decide what our pilot is going to be each year that's related to revenue? I remember something about that. How does that work?
Yeah, we have a formula.
What is it?
You want to take this away, Jack, or would you like me to?
No, I'd like you to take it, please.
Okay, so we take our kilowatt hours that we sell each year,
Uh-huh.
we multiply it by 0.0025, so 2.5 cents per kilowatt hour.
Okay, and that's it, right?
That's it.
That's what I thought. I thought there was such a formula, but I couldn't remember what it was, so thank you.
there is a formula that we, and every light department bases it on something different. We chose to base it on our kilowatt hours sold.
Okay, thank you. Back
Okay,
to,
moving
okay,
along.
but on
Go
page
ahead.
15,
Okay,
the light plant collects sales tax. What do we collect
Right.
sales tax on?
commercial customers are subject to sales tax on their, if they have more than a certain number of employees, yeah, there's actually sales tax.
Oh,
on
I had no
electricity.
idea. Okay.
Yeah,
So commercial
And residential
customers
ORL.
over a certain size.
In our residential, or outdoor rental lights.
I'm sorry, I didn't understand that, Joan. Say that again.
We also collect tax on our residential customers who have outdoor rental lights, ORL.
Outdoor lights.
Yeah,
security
rental
lighting,
lights.
Street
Yeah, you
lights,
can rent a light from the light department, but you do have to pay
parking,
sales tax.
parking lot lights.
Oh,
Right, you can-
okay. Okay. Thank you.
any other questions, Laura?
No,
So
not,
far?
no, I'm good.
Okay.
We're up to page 16 now, right?
Page 16, so note number 3 talks about the insurance reserve. It's been established for a while. Note 4 talks about the rate stabilization fund and the respective balances each year. It's just a verbal.
Do we have our own I'm trying now, the other question I have is these various funds that are invested, like the insurance reserve. Are there, I see that that some of it's invested at Rockland Trust. But that's probably like cash kind of stuff, I guess. Are there restrictions on what we can invest in?
Yeah, in Massachusetts, municipal cities and towns are limited in what they can invest in. There is they call it a legal list of investments that are available.
Is our list the same as the town's?
Well, the town is the one who controls the investing generally of the money. So
Okay.
yes, yeah, the list will be
Okay.
the same for all municipalities, yes.
So the investment fund is basically invested by the town treasurer and is
Yes.
controlled by okay, thank you.
But
I
these
did notice-
investments, these aren't invested, these are in just like cash accounts earning, you
Yeah.
know, money market type thing. Okay.
Yeah, okay.
The rate stabilization fund, I noticed the last sentence on note 4, page 17. Excuse me. We talked about it does include that green power, so we wanted to list that. And I think next year I would probably agree that we could split that out from the rate stabilization or sub account on the books and highlight what that's used for.
Okay, so this is where you say the fund, okay, I didn't understand why it had a balance of 0, but I see it's at 2020, December, the end of 2020, so I get it.
Right,
Thanks.
the transfer was made. It was a bit awkward time-wise, but
Yeah,
we
okay,
found a way to handle it, get the right result. The depreciation fund, so again, this is money invested by the town treasurer. And there are, you can see there are municipal depository trust funds, government securities, money market funds. So that is all invested in it, and it shows the years of the fair market value of each investment.
okay, I wonder if, I did not understand this sentence at all. The last sentence, fund is managed by the town treasurer, may be used for and deferred costs related to such commitments which the municipal lighting board determines are above market value. I didn't understand that at all.
So traditionally, the depreciation fund going way back was only available to be used for plant additions. That was the intended use. It still is.
Oh, so this is the new,
This was
thing
the,
that-
when they did restructuring, this was the wording that the state put in. It's just been carried on. I don't know that I've ever seen it used for things other than plant in light
Okay.
departments, and we do quite a few light departments, so. But that's
So
the
they-
wording that's in the statute.
okay, I get it. Thank you.
Note 6, other receivables, there's your merchandising and jobbing, solar credits receivable that was sold, and interest receivable, 1.1 million. as you can see, a lot of the balance sheet accounts are now, have a lot more detail of what makes them up here. So the purchase power working capital. So there's a Watson plant. I believe that's the Braintree. You have an investment there or some funds on deposit. MWEC, a small amount with some projects you're still involved in with that MWEC. And then Energy New England, E&A 1.7 million, which is your primary
Power supply.
power supply agent. Investments, note 8. You have a very small amount in Hydro-Quebec.
Could you pause for a moment and
Sure.
explain this in a little more detail? I'm not sure I quite follow where the money goes and who decides what happens with it, et cetera, and what it's spent for.
This is the working capital funds.
Yeah.
It's basically a deposit held by E&E in our name on our account, so that it's money. So what happens? You only have so many days to pay your power bills.
Mhm.
So if you have to go through the warrant process in a city or town, that sometimes can take some time. By the time everybody signs off and the checks are printed, or
Oh, not here. We sign them immediately.
Okay, that's typical, but it still takes time. So what happens is, this is the major expense to run this department, is your power bills.
Yeah.
So they need to be paid timely, and so you have to put funds up on deposit with the E&E. And once those bills come in, they pay it out of that, and then they send you a bill for the monthly accounts and monthly expenses, and you simply reimburse at that point.
Okay.
It's just, again, it's just timing. It's just make sure the bills get paid on time.
Okay, great. Thank you.
Okay. Investments, we talked about Hydro-Quebec stock. Most departments through, I think it's through Emmerich years and years ago, had a little tiny piece of that. Hingham Lake Department also invested in as we mentioned earlier, Energy New England, initially a 5% interest, and then an additional 5% interest when there was some restructuring going on there. So that's the total, most of the 300,000, that total investment in E&E.
Mhm.
Net investment in capital assets. So your gross cost of plant acquired, and this is from day one, from the time you were incorporated, you invested $66 million. That's net of retirements. So you would have bought some assets over the years and retired them, so that wouldn't be included there. The depreciation on the assets we do have in service, 40 million, so your net investment is 26,430,000. That happens to be the net position on the depreciation side. Now, had there been if you had any bonds, had you built a new building and bonded it, or had any debt, that would come off of that amount in terms of calculating your net position. Okay.
Laura, the other thing I wanted to mention was, you remember earlier at this meeting, you mentioned that there's an 8% gross cost of plant that you're allowed to earn as a light department. So what we would do is you look at 2019, 65 million, and multiply that by the 8%, and that's what you're allowed to earn in this year. So for next year, you would do the 66 million times 8%, and that's what you're allowed to earn for 2021.
Got it. Thank you.
There has been some discussion I've heard in different circles about whether the 8% is on gross cost of plant or net. We've interpreted it, and we've found that we believe that the 8% is only gross cost of plant, according to the way we reach after 164. But I have heard discussion of it being on net. In how many years of experience with light plants, we've never had the issue come up. So generally, departments aren't trying to make more than 8%. That's an unusual event that's going to occur for you to make that much money. Okay. You don't want to set your rates to earn more than you really need to make sure you cover your bills and have adequate reserves. The next note 10 is really the breakdown, a little more breakdown by classification within your capital assets. So you've got some assets not being depreciated, land doesn't depreciate, construction in progress doesn't get depreciated until it's actually placed in service. Those are new projects going on. And then you get your assets.
I'm sorry.
Yeah.
Total
So
capital, that's what went on this year? And it
in
will
the
go
increases
next
column.
year?
Yeah, the increases column is what went on this year.
Okay, and that amount will go into the amount being depreciated next year?
Yes, correct.
Okay.
Well, the amounts under the capital assets being depreciated, those additions, the total is 1,529,000. See that number in the second column over? And the increases, 1,529,000. Those are the plants additions that we actually place in service. The 864,000 up above is a construction projects that are going on now, they're not complete. So ultimately, when they complete, those will move down into the plant down below. Okay. And then there are some decreases. We always, DPU got a little upset many years ago. They said, you guys aren't taking any of your retirements off the books and you're entitled to make 8%, or you're entitled to take 3% depreciation on those. So you're inflating your depreciation funds. So we always take a stab at saying, okay, what, were there poles hit by accidents? Let's take some assets out of service in form of retirement. So every department takes a stab at saying what assets retired. Okay.
So I didn't understand the three categories under capital assets being depreciated. There's two called depreciation plant.
Yeah,
and
that's a
one called-
typo. I'm sorry. The top one should be
distribution.
transmission.
Oh, okay.
That's a typo. I'm sorry. I found that today.
Okay, so okay, then that
first one,
makes
just-
sense to me.
Yeah.
So that's transmission plant
Yeah.
and distribution plant, and then general plant is just like everything that isn't directly related to.
That's where the vehicles would be. You asked about this morning. Vehicles would be
Yeah,
in general
okay.
plant.
Vehicles,
Okay.
buildings.
Yeah.
Okay, great.
What else? Office furniture and equipment,
Mhm.
that type of thing.
Okay, thank you.
Okay. So the net down at the bottom, very bottom right-hand column, 26,430,000. That's the number that keeps coming up in terms of on the asset side, the balance sheet side, the net position side. That's that number that keeps popping up. Related party, I won't go into it, but as I explained before, that's the interaction between the town and us. We are part of the town, but we do keep separate books and records, so we have to record the intercompany transactions. Note 12 talks about a lease of some antenna space and material. Note 13 goes on and on and on, the pension plan. Did you read, there's any questions on it? I'd like to point out on the pension on page 22 is a lease of interest to most of us, a little bit of reading. Those explain the deferred inflows and outflows. And as I explained before, those are timing differences and differences related to the assumptions that the actuary makes. So again, we don't get involved. These numbers are all provided to us by the actuarial report. And down below, the 5-year history is how those are going to be amortized. So let's say, for example, let me use an example. Let's say we project we're going to make a 7% rate of return and we make a 5% rate of return. So all of a sudden we lost 2%. We didn't make what we expected to. Well, that'll change the actual assumptions going forward, and it changes the number. So rather than take that hit all in 1 year, why we didn't design this, but the AICPA or government agency decided to do it this way. Rather than take the hit all in 1 year, they're going to amortize that over 5 years. It'll be a rolling forward every 5 years. So we'll drop off 1 year and add another year. So I guess that's
all related to pensions.
all related to pensions, and it's very similar to OPEB also.
Well,
Back in the day, they required us to bring on the entire unfunded pension liability. They didn't say bring it in over 5 years. The OPEB, however, they were amortizing that over, and I don't remember the number of years. Joan, was it 10 years? I don't remember the number. It was going to be amortized when it first started. And then when the pension changed to full funding and brought on the balance sheet all 1 year, they say, well, why are we doing OPEB differently? And that got brought on. So it's all even footing now, but it's all liabilities are there. So
sadly, I do have a question about on page 21. There are a couple of references to, like, for example, a third paragraph, employees who resign from state service who are not eligible to receive or Why are we referencing employees in state service? I was confused by that.
I think you're part of the state, legally, you're part of the state pension, even though.
So this is sort of just lifted like from the prim.
Yeah.
Yes, I believe so.
You know,
Yes.
okay.
Yeah.
It seems unclear to me, but.
Yeah, you're part of a larger group, I think is the problem here.
Okay,
Yeah.
it's probably wiser to just take their language and roll with it. Okay, thank you.
Okay. All the actual assumptions I see begin on page 23. Then it talks about the investment policy, page 24. The information that is of interest to me when I read this is bottom page 24. it's always interesting to see, again, one of the actual assumptions is the discount rate. And it's right now at 7.4%. So it's interesting to see a 1% swing one way or the other, how drastically it changes the liability, either up or down. So as you can see, this whole pension business, this whole pension liability is a moving target. It's going to continue changing with inflation and all those other factors that the actuarial takes into consideration. So
is it the actuaries who decide what your current discount rate should be?
Yes.
I think the actuaries in conjunction with the town. I'm not sure. I believe, is there any discussion? If that's done at the town level, or the retirement board level. So I'm not quite sure how that all shakes out.
You'll see when we get to page 40, the footnotes, they actually had a discount rate of 7.25 last year. So they do monitor it and change it as needed.
I suggest the actuary must make a suggestion, or the investment advisor must suggest what they predict is going to happen. So page 4, note 14 on page 25 begins the same type of discussion in disclosures about the OPEB trust fund.
And I flagged this phrase, an actuarially acceptable period of years, but what you're telling me is they're changing that all the time.
Yep.
Yes.
Okay.
So again, when you get to the investments on the OPEB side, the disclosures require us to determine what level of investments they are. So sort of like low risk or high risk. In all light departments, what we've seen, you're all in level 1, which is the lowest risk, and you're all living by the rules of the land, as far as the legal list of investments. Okay. So on page 26, it breaks down the types of investments that we're invested in.
So the OPEB funds are invested exactly the same way as the pension funds by the town treasurer?
Yes.
Yeah, okay.
The investments for the pension fund, are they, we don't have our own pension trust fund, it's the town's
Right.
fund. So there's a pension system in town, correct, in Hingham?
Yes.
So that's handled at that side, okay.
So they handle OPEB too, is what I'm asking?
Now
Not the
that I think about
retirement
that,
board,
I don't think so.
not the retirement board, the town treasurer would.
Tom?
We have our own investment policy statement.
Own investment policy, but who does the actual?
So who does
handles the
I
money?
know the money's, I believe, with Rockland Trust, but who monitors it? Do you have a committee, or does the town oversee? I don't recall, I'm sorry.
Oh, they come in once a year, we lose account with them, with Rockland Trust.
You hear, Joe?
Rockland Trust comes in once a year and goes over it with us to make sure they're in compliance with our investment policy.
So we're investing it with Rockland Trust, not the town.
Correct.
Okay, thanks.
Okay. The 14 continues on, land description. On top of page 28, we have the summary of the OPEB. So our liabilities right now, 3.3 million. And we have put aside, sorry, we okay? Okay, we put aside.
Can
Yes, go
we ask everybody who's not speaking to mute? There's a lot of background noise, just every little shift and whatever. So
Are you hearing my papers? Is it me?
I don't know what I'm hearing, but
It may have been me. I was flipping. It could have been me. I didn't realize. I'll be careful.
It
I
might
think
have
it
been
was
me too.
the office, when you're moving things around that desk, that when Joan was moving the speaker, that was a little noisy, but anyway. All right, so the net pension liability right now is a 1,306,000.
OPEB.
I'm sorry, LPAB liability. Good thing Tracy's here. So 63% funded as of the end of this year, up a little bit from last year. Even though we didn't put any additional funds into it, the investment earnings increased the balance, and we're staying pretty steady with that. There are, again, my favorite things to point out when it comes to OPEB is that's one, how close are we to fully funding? And the second one is what happens to the actuarial assumptions when they change a little bit, like the discount rate on the bottom page 29. 1% change from the $1.3 million obligation could make it 1.5 million or 1.1 million. So again, it's a moving target. Now, in terms of actual assumptions, there are two disclosures on the OPEB. One is the discount rate, but on the next page, there's the cost of the healthcare trends, the cost of healthcare, which we're now saying we're estimating is going to increase it it's going to decrease to 4%. And then a 1% increase one way or the other. Again, your numbers are not that large, frankly. You know, you're so close to being funded. It's not a huge amount of money. Some departments who are not funded, the swing here is pretty drastic. You're in pretty good shape. You're very good shape. Note 15. Again, now we're talking about the provisions of the plan. Who's covered, who's not. And on page 31, we get back into that issue of the deferred inflows and outflows, the timing differences, and how they're going to be amortized over the next 5 years. This one, again, you're pretty close, even on the assets minus liabilities is almost a wash.
So to make sure I understand, on page 30, bottom, you OPEB liabilities, this is, the liability is what's paid out plus additions to the fund, or? I'm not sure.
So what page?
The liability is just what we owe total forever as of to this year's actuarial determination. Is that right?
Oh, the 3.3 million, yes.
Yeah.
Correct. Okay. That minus the amount we have set aside is that current liability, yes.
Okay.
Okay. Note 16, beginning on page 13, we're getting into the risk management discussion. We talked about your self-insurance trust, which is a method to try to avoid potential liability. You've got some money set aside for that. You're also a member of the Municipal Utility Self-Insurance Trust Fund. That's different than the money you have set aside for insurance, the insurance reserve. And we talk about what your benefits, your coverages on all that. So that's, and most departments do belong to that, or many do.
So I didn't really understand the relationship among all these things. We're in the Mass Municipal Utility Self-Insurance Trust Fund. And then the next paragraph says the town is also self-insured for those employees electing indemnity plans. And for general liability.
That's related to health insurance. The first paragraph is related to disaster or liability type insurance. So it's two different types of insurances.
Okay. And then the town is self-insured for other general liability.
Yep, different coverage. Additional
and how
coverage.
is that different from the liability in paragraph 1?
Well, it's different coverage. You have a specific coverage with the Mass Self-Insurance Trust for transformers or environmental issues, where the town would have probably liability for the town type being in the town issues. They must have extra coverage. It's something that's been there. Joan, do you know where this piece of the footnote came from? It's been there for a long time. I guess we never go back and check it.
It's been here since I've been here.
Yeah, me too.
Additional liability policy.
I think the town has it. I was going to say the town has its own liability policy, which covers all departments of the town. If something goes wrong, something, you know, there's a claim against, for some person claims a liability for the town, but the self-insurance trust is really related to the industry issues that might go wrong in the industry.
So claims would first go to the self-insurance trust fund, and if not covered by that, then you'd go and see if it's covered under the town's general liability.
Yes.
Okay.
Yep.
There could be double coverage here, possibly.
Mhm.
You know, so which one would pay first? I'm not quite sure. I know the town has to carry its own liability policy. As a department of the town, I suspect we're covered.
Okay.
Okay. Note 17, again, under commitments and contingencies now. So here we're disclosing all the contracts. I don't see this in every light department's footnotes, but this is very detailed description of every contract that you're involved in, and you know the time frame and all that stuff. So this is just interesting reading, but it's a little much.
I had one question on page 33. It says, it's second from the bottom, comes up a couple times. HMLP is a 2% entitlement owner. Is that a word of art, or I was speculating that that meant we are part owners and we are entitled to a certain amount of the output? Is that what that means?
A second thing, yes, we're entitled to a certain amount of the output, yes.
Okay,
Through contracts through Emmerich and NIPA, yeah.
okay.
Okay. The bottom page 35 shows the Emmerich projects that we have a small entitlement. I guess that's where that percentage share, that's the entitlement where it comes into play there.
That's a percentage share of the facility's output that we're entitled
Yes.
to. Okay.
Yep. And then subsequent events, the last footnote, page 36. We just disclosed that during 2021, the plan transferred the operating funds to the Green Initiative Stabilization Fund. So it's just, again, to illustrate a timing difference, that it was voted on appropriately in 20, but not transferred till 2021.
Okay.
Okay. So under the required supplemental information, these are again fairly new disclosures last few years. In this first page on 37 is the pension liability, and it gets the same information we've just seen. It's just put it into a schedule format. In this report, ultimately, is going to go out 10 years unless they change their minds. We're going to need longer paper, I think, throughout 10 years. So it began in 2015, and we're up to 2020.
It's gonna have to go sideways.
Yeah. 38 is the same thing for OPEB. And that began in 17, and it ultimately will go out 10 years. Requires supplement information on the operating and OPEB trust fund. This is it, again, it's part of the 10-year schedule, Tracy?
Yes.
Okay. The bottom of, I'm looking for the percentage of funded. Oh, there it is. It's on page 39 about the first subsection, 61% versus 63. So actually it went down a little bit. You were 74%. So the actuarial valuation every year are gonna change this thing. And we'll see what happens with everything affects the economy and whatnot. So page 40, note A. Again, under supplementary information, other post-employment benefits, change in assumptions. All good reading information when you really can't sleep. Page 41 are just other disclosures. It's a little more detail for the statement of income and expenses. So this breaks down your sale of electricity by a class of customer, residential, which went up from last year. And I think I'm hearing one good reason for that is a lot of people were working at home, whereas commercial and industrial went down. Many places were closed. Municipal went down slightly from last year. So overall, the amount was very, very similar to the previous year in terms of income. And then the detail of the expenses on page 42. Power costs remain pretty stable. Other purchase power, 504, total 19.7 million. Miscellaneous distribution expenses, maintenance of lines, looks like going up quite a bit. So you must have a lot of work being done in the town to, protect the integrity of your system, which municipal light departments typically do. Customer accounts expenses, accounting collection up slightly. I can read all these numbers, but I think you can do that yourself. But I think when you look down the bottom, you're pretty consistent. But on the general administrative, there's probably the biggest increases there, and it's every year, every department we see this. It's under the pension and benefits. That's your OPEB and pension expenses. That's about almost $500,000 increase. So that's where we have to watch the money. So again, back to my comment about these are our expenses. The pension, the employee benefits are an expense we're recognizing, and we're building it into our rates. So the concept is that we're collecting the money from our customers, we're actually putting that money aside. And cities and towns are reluctant because they don't have the cash flow to do that. So light departments as an enterprise fund, we like to fund the liabilities that we have. And I think, Hingham, among most of the light departments, are doing a very good job with that. To the extent that you're able to.
Am I reading this correctly, that under customer accounts, we had a negative entry of $83 as uncollectible accounts in 2020?
Yeah, so we must have recovered some uncollectible accounts.
Uh-huh.
So it netted out to a net increase in income as opposed to an expense. It's a little unusual to see that, but
Pandemic notwithstanding.
yeah, and the reserve account we have set up, I believe, stayed the same at 50,000. So it's always a reserve, and we adjust that, based on like a 3-year rolling average of write-offs of accounts you're not collecting. So I guess that would be a comment that your collection people are doing a very good job at staying on top of your accounts receivable and managing that very well.
That's remarkable.
Yeah, especially considering COVID and moratorium on interest charges and all that.
I think we were expecting something different.
I agree. We have one other report that Tracy could present to us. It's probably not very exciting, the management report.
Sure. It's called the internal control development. When we go through your procedure of the auditing, if we find things that are of significant concern, it'd be where something we could address it in this letter to the board. But what we've been noting for the last several years is just the drafting of the financial statements. It takes a lot of CPE and current knowledge to stay on top of the OPEB and the changing pension, and doing the disclosures and doing the cash flow statement and just the presentation overall. So although I do appreciate Joan's input, and she's a CPA and is qualified, staying up with some of these other GASBs can be time consuming and significant. So we don't have any actually departments that don't get this comment. Every one of our statements that we do, we've had, we've had discussions with whether they are they have the ability to draft the statement. So I don't know that it's of a concern. It's something that's required by the AICPA that we put this comment in there if we don't get a full set of financial statements from our client, that we could just put our audit report on and send on its way. So it's something we do for everybody. There's no other items that we noted during the audit that we unfortunately had the delay with the update of your software. So the timing of this audit is much later than it normally would be. We always get it done for the May meeting. Unfortunately, they did a software update in May, which postponed our ability to start. So the timeliness is not great, but you weren't able to recover the software. Otherwise, that would have been a comment that I considered putting in this report because you didn't have the backup at the time. But it took them a month or two, but they did get the backup back. So those are the kinds of issues that we might report in this kind of item. We actually have some departments that have inventory issues where they don't have a handle on what's going in and out of the inventory, but we've never had that problem with Hingham. They're always right on with their inventory. So different various things would go into this type of report. But luckily for this one, we only do the drafting of the financial statements, which again is done by every audit that we do.
Getting the impression for what you're saying that congratulations are due to our accountant and our general manager for the accuracy of our reports. So I pass those congratulations on behalf of the board.
Thank you.
That's the end of this report.
That's it for us. Any other questions that we can help you with?
And we get to start this again on Tuesday, Tracy.
On Tuesday, we start again. Yay!
Audit for next year.
Yeah.
It's exciting stuff.
We
Always.
do begin our process right around this time. Have we had our brainstorming meeting, Tracy, already?
Yeah, we had it last week, Will. Yes.
Well, I was away. That's good.
Yeah, you're away.
So I have a question that's sort of just raised by looking at these statements. As you know, we've got a big project in the offing. And so we have all these reserves. We also are going to be looking at getting borrowing authority at town meeting next year. And so one of the questions is going to be, we're in a low interest rate environment. Do you have any thoughts about the strategy of using, spending down our reserves before we borrow, or borrow now because it's cheap? And
What's the estimated total cost of this project, the transmission line?
Well, the number we're throwing around now is maybe as much as 50 to 60 million.
Yeah, that's what I thought.
And so we're adding to our reserves at, 4 or 5 million a year. So it's going to be a number of years before this project gets completed. So the funds aren't going to be required immediately. And we have, I don't know, what's the number, like 20 million or something in reserves now.
The other thought that I've been pushing around is where it's a transmission line, typically when you do work in process, it stays in work in process until it gets energized. And my concern is having a $50 million project that might span a couple of years. You can't even start depreciating it until it gets energized. So
Right.
that also limits the ability to collect current depreciation on it. So there does need to be some kind of a budget to determine what you need for cash flow, what you can use for your reserves versus what you borrow.
Right.
Borrowing is not the worst thing in the world with the rates low right now.
Right.
But I have a further
So anyway,
comment.
I just wanted to raise it because we may be looking for some advice along the way. It's going to be a calculation that Tom and the board are going to have to make. So
Jim, thoughts?
Yeah, I think a couple thoughts. One is the interest rate of borrowing is extremely low. I'm at Treasury, my water department, and we just built a new water tank, and it was very economical to borrow the money while we could have paid for it with the cost of interest now. But my thought with the light department is that if you have adequate reserves, not enough to pay for the entire project, but remember, once you put the bond in place, you got to pay the principal down. So you might be saying, well, wow, look, what are we gonna have to do to our rates to increase our rates to cover the principal payments and interest? Are gonna be doing this large note. So my thought is, if you have the reserve set aside, that reserve could be there to pay down the principal interest, so your rates would be neutral. You wouldn't. This whole project won't affect your rates because you're building enough in advance, and then you have that money to pay down the debt over time. So you wouldn't have to be increasing your rates to cover this major cost.
I don't think we're going to have 50, 60 million dollars in our back pocket.
No, you're gonna have to borrow some
No,
money.
you're gonna have to borrow some money.
Yeah.
I'm thinking borrow all of it and then use the reserves to pay the debt down over the years, when you're paying the debt down over, say, 10 years or 15 years, whatever the term of the note is. Because if you didn't have the reserves, you borrow $50 million, and let's say it's going to cost you 5 plus interest, $6 million a year. Where would that have come from? You have to raise the rates. That's a substantial hit to your if you can increase your plant and have it much more efficient without costing any money because you've got the reserves to cover it. I think that's the way to go. Again, something to consider when it comes to fruition here, but that'd be my line of thinking.
yeah, well, I think after town meeting next year, we can have a more detailed conversation. We'll know better about the rates, and
Right.
looks like now they're not going to increase greatly in the next, but they may start sometime next year to ratchet them up.
There's always that concept, you could borrow it at X number of percent, say 3%, and keep your money invested at 5%. I think there's a naughty name for that, arbitrage or something like that. The big IRS or the Department of Revenue doesn't like you to do that. That's kind of illegal. So if you borrow in excess of what you really need, yet you're keeping the money invested. I don't think there's a requirement that you have to use a depreciation fund for this. You could keep that invested.
Right.
So those are the considerations you got to consider when it comes another year from now, I'd say.
Yeah. All right. Well, anyway, it's it's something we have to wrestle with especially once we get better definition on the cost of these projects. Right now, we have estimates, but we'll see what happens when Weymouth finishes beating up on us.
Would you be getting any? I'm trying to think the right name for it. No, would they have? They get credits for having transmission as part of the New England grid. I'm sorry, I can't think of the name. Tom,
Yes,
help me out.
that's if you're a PP,
Yeah.
a loop system,
PTS
You end up being
credits?
part of the system.
PTF.
We're gonna be radio, so we're not considered, I can't think of the term, but we're not
PTO.
considered that because we're radio.
Okay, that's too bad, because the credits can be
Yeah.
substantial.
Well, Tom,
Yeah.
maybe we can give Hull a tap off of our substation and become a part of the grid.
Yeah. I don't even think that works, Jack. I think you have to be connected so that they can feed in and out of you.
Yeah, okay.
Okay, good thought.
Well,
All right,
my big concern in this area is that we will have to give voters some idea of what the impact on rates might be when we go to town meeting. And it seems that coming to any kind of plausible statement on that right now is just very difficult, just because of where we are in the project.
Yeah, well, we'll give them our best estimate at the time and they'll have to live with it. What else can you do?
That's all you can do.
I think you have a strong case for saying that there'll be no impact on the rates because of the reserves you set aside, plus to keep the depreciation to 5%. Naturally, the 3 to 5%, that 2% increase, that affected the rates or could affect the rates. As you notice, your profit was less this year than previous year. So, but again, your rates are adequate to hold that 5% right now. So there's no reason going through forward you shouldn't be able to.
So
Right, and,
I'm
you know,
confused by what you said. We don't have $60 million in reserves. So are you
No,
talking
no,
about
but-
ongoing depreciation from
yeah,
the rates?
over time, the additions annually will probably more than fund the carrying cost of the borrowing. And if not, we have 20 million bucks in reserves to supplement that. Is that about right?
That sounds right. There'll be some combination of using existing reserves plus the increased depreciation reserve that you went from 3 to 5%. Let's say that's $2 million a year. That plus your reserves, you'd be able to go for quite a long time before you'd impact your rates, I think. We have to run all these numbers and see how it all shakes out once you get the cost before you
That
go to
would
town.
be very excellent news to be able to take to town meeting if that were the case.
Yep.
I feel better now. Feel more optimistic.
Well, well, anyway, I think unless there's any more questions, that was a great presentation and thank you for getting up early.
Can we ask if there's anybody from the public who has questions about our financials before we move on? I don't see any.
Okay, all right.
Okay,
Good. Well,
thank you very much for your attention and we'll see you hopefully in the spring,
Yeah,
earlier spring.
yeah.
Thank you,
Right.
Jim. Thank you, Tracy.
You too, Dave.
Bye, everybody.
Thank you.
Okay. So Tom, do you want to talk about Watson next, or do you have?
Yeah, so we have Laurie Heffron on. Laurie did an analysis that I think I sent that, I put that in your package, Jack, and
No, I
sent
haven't.
it to you.
Yeah, I
So
haven't.
Laurie's gonna go through that.
Morning. Nice to meet everyone. Can you hear me okay?
Yes.
Yep.
Okay. So what Tom sent you is just kind of a little summary of Watson and the capacity, the contract that you have with an initial term of 20 years. At that time, if Braintree continues to operate the unit, you will have the option to extend that unit, that contract for the 10%. I tried to put together a little bit of breakout of the capacity, the energy, and just the overall impact it has on your power supply. There's some great points to note about Watson, and you were touching on it a little bit as you started talking about transmission and whatnot. But as far as capacity goes, the power pool, 2 years in advance, they look at capacity zones and they take into account any constraints, and that can be transmission constraints, it can be capacity constraints. and they have different zones that you, as a load serving entity, may settle out in. So what happens is most of the time, Hingham will settle out in what's called rest of pool. And that means basically there's no constraints in your area. There have been those times when Hingham has had to settle out in the SEMA Rhode Island capacity zone, which it is in, and that means there was a constraint of some kind, capacity, transmission, or otherwise. There's also a southeast New England zone that you settle out in. 2 years in advance, they have those forward capacity market auctions, and so everybody enters their price in, and when the actual days come, and it can settle out a little bit different, those rates. When Hingham had to settle out in the SEMA Rhode Island zone, those rates were almost 4 times what rest of pool rates were showing. So having the 10.5 megawatts of Watson in your zone, you were able to self-supply that. You couldn't self-supply any other capacity from every other contract that you own and have capacity in because you were constrained. So if you had not had that, it would have been 10.5 megawatts times 4 times the rate. Go ahead, Mara, you had a question?
Yeah, no, I'm sorry, because for me, this is the most complicated part of our business, and I'm new to it. So when you say settle out, that means we bought our forward capacity at a certain price, and we have a certain amount of it. I don't really understand how. I mean, we have forward capacity, but do we buy it like, okay, on July 31st of 2023, we'll have this much capacity available to us? Is it according to days, or is it according to periods? How does that work?
Right. So they'll look at the typically it's for each month. They'll look at that, but so their forward capacity market, if you will, starts from June and goes until May, and they use a peak from 2 years ago. And then they'll look at what Hingham's coincident peak with the pool was. So that's how they base it. And then they add in reserves, which are that increases your load obligation significantly, depending on what's going on, what they foresee in that 2-year outlook.
So reserves are just their speculation about how this might change over the
Correct.
period of time for the auction.
Correct.
So
And
I'm sorry.
they're looking at biggest contingencies as well. So if they should lose this unit or this transmission line, they have to factor in a certain amount of reserves. So they'll look at load, they look at what they know at this point in time they have available for capacity, and all of the contingencies that go along with that. It's another one of those nice big formulas and calculations.
So when it comes time to settle out, we arrive at the moment where we have bought capacity for, but we're talking about what happens if we don't have enough capacity, if we have not bought adequate capacity for that moment.
Right. It's what happens when I say settle out is what happened in the real world. So so the pool looks ahead and then says, okay, Hingham's coincident peak was this, and this is their load obligation on top of that, with reserves. And then what did they have at that actual time for that month? Did they have what was available? So they'll settle
presumably we had to buy some stuff that we hadn't bought in advance to cover,
right.
And that is at a spot market price?
Right. Yeah. It's like a spot market price. It's very involved and convoluted, but I can give you more detail on it. if you do have insomnia, I can definitely get you.
I would like that. And believe it or not, I would really like to have that so that I could ask fewer questions.
Sure. So that I feel like it's the capacity of Watson with what you have to pay in debt service. It looks expensive until you see something like this where it saved you in one short period of time, a year to a year and a half, $3 million more you would have paid to the pool, if you didn't have Watson and you couldn't self-supply that capacity for that zone and that restraint that you had. As far as the energy, it's roughly about 5 cents, just under 6 cents, I would say it averages out per kilowatt hour. So it doesn't pull in your capacity, energy, all of the debt service that you're paying, it's not increasing Hingham's cost. If you look at your overall power supply, Hingham has remained very stable. You'll see times where your load increases by 11 million megawatt hours or 11 million kilowatt hours, I should say, over the prior year, and you're still remaining quite stable. Obviously, the goal being to optimize short and long-term energy contracts with where how much open position that you leave to the pool. And that's all on forecasting energy and looking where fuel costs are going, whether you should buy bilaterally and what that market looks like versus, leaving that open piece to the pool. But I think overall, Watson, not to leave out that it is another muni utility that you're buying from who good utility practice, that they take care of that unit, that they do the right thing by that unit, that they do everything they can for fuel procurement, I think had a lot to do with it. And when the discussions were probably going on, I would imagine with the forward capacity market coming, that it started in June of 2010. So I'm sure that played into it. New world, new market regulations. So I think all in all, it's a good purchase. It's a stable unit. It's reliable. And I will go through. I had mentioned to Tom that I requested GADS data, which is just generator availability data from John Eric Nelson over at Braintree, who is a stellar human being and one of the best mechanical engineers I've ever met. He gave me 200 pages worth of the generator availability data in a format that I could not, total for you to give you the actual availability. Most of what I could see, though, in the PDFs was just when Watson was quote unquote shut down, it was reserve shutdown. So that was the pool doing central dispatch and having Watson available. They'll do that from time to time where they may not need the load, but they'll back a unit off. They know they can ramp up fairly quickly and have it on as reserve. So
And do we get compensated by ISO New England when this
right.
asset that we own is available to the grid?
Right. You have all of those little pieces of the puzzle with the pool. So you have, there's different things with transmission too as well. You have auction revenue rights, and there's all those breakdowns that I can show you too, where those are the two small, there's a couple of small little revenue streams you get back from the pool. Mostly you see all these big numbers and expenses, but.
If you have such a thing as a forward capacity primer that I could study, I think I would be a further.
Be careful what you wish for. Yeah, I'll download for you from ISO. The how it works. The whole forward capacity market and how that plays out. Absolutely. Yeah, and I can give it to Tom. He can email you if that works best for you.
Sure.
But I tried to keep the summary simple on the back of that, or the second page of that. I just tried to show you where your overall, Hingham's overall costs are and how your rates have looked. And especially over the last 10 years, you really haven't fluctuated more than your total all-in power supply cost being under 10 cents per kilowatt hour. So it's pretty nice to see the stability. And I think obviously, like I said, that goal is to optimize that portfolio you have. You have a nice mix of units between nuclear, fossil fuel, and your renewables. And so Energy New England looks at that constantly and tries to manage what's the optimal position to have. And they provide Hingham with weekly outlooks on where they're at and what the forecasts are. So. But if there's any questions or if there's anything you want me to delve in and give you more detail, please just let Tom know, and I'd be happy to provide you with that. The debt service, like I said, I'm working off of an estimate that Tom had given me, but I think Braintree's slightly under that. It seems to me they're coming in less than that. I'm not realizing those total costs. It's close, but I think it's probably a little less than they had estimated. But the debt service should be fully paid by 2029, and you should see a significant decrease in 2028 in that, to the tune of about $500,000 less than the annual capacity. You see that big hit in February, and then there's another one in August, which is where they collect that.
Laurie, I have a question. Do you think we should be looking to get more of this with Braintree? I mean, they're retiring one plant,
Mhm.
my understanding, and if they decide that it's in their interest to replace it, is that something that looks like it would be cost effective for us? I mean, we're trying to stay away from fossil fuels, but you need backup.
You do, right, right. I mean, it's something to look at. I would want to see the numbers of it and what they would be building. But if you're talking just more of Watson, that's certainly something you could look at. But I would want to see what they would draft as a contract and what the numbers would look like.
Yeah.
Yeah. Yeah. Like you're probably you have quite a bit of nuclear, so you're at about 28%, I believe, of your mix is nuclear. But you have, it looks like when I do the energy supply reports, a low amount of fossil fuels, but you have a lot of system contracts. So if the pool's roughly, they do a lot of snapshots in time, so they're roughly 65 to 75% gas at any one time. So if I take that percentage of your system power contracts, I'd say maybe you're probably in the 30 to 40% gas fired. So, but you do have quite a bit of renewables. Like I said, it's a decent mix of portfolios. Like I know you're probably thinking we don't want all our eggs in one basket, especially gas and where that's going. But I would be interested to see what Braintree has. Like I said, I've always liked the idea of muni to muni, especially where they're local and you know who they are, then you know the job that they do for a plant and how they're going to run it. So that's important. You want that thing on and running for you when it's in the money. And if it's not in the money, then that means you're buying from the pool cheaper. So that's fine too. And you'll get those capacity credits for being available. So, but yeah, I would definitely be interested to see what they do and take a look at what they would craft as a contract.
Thing that I learned from attending the ISO New England Consumer Liaison Group, which is where I'm trying to get up to speed on this stuff, is that currently renewable generators are not eligible to participate in the forward capacity market. Do I hear that right?
That's what I've read.
And they're trying to, there's some talk of making a change in that, is what I understand.
Right. And I think it's just the nature of the beast is the fact that they're renewable. So it's the availability, I would think. That's the problem. So I'm sure that they did try to, change instead of penalizing people for not being available, they've offered a pay for performance program, I think, to try to just incentivize units to be available and to be there for that market. But yeah, I mean, I'd like to see what they do for that. I mean, I think they do make an effort to incentivize units and availability. So it would be interesting to see what they do with that.
Okay. All right. Well, thank you, Laurie.
My
Thank you
pleasure.
very much. That was very helpful.
Okay, nice to meet you. And I will work on that forward capacity market for you, Laura.
Thanks.
All right.
Okay. What have you got next, Tom?
We're down
Next
to,
is the Mass CEC grant. So that was the program that we were working on with Monia. I got a letter, an email from Monia, and in that email, he stated that for a number of reasons, they were only going to submit for one town. So I guess the grant was due Monday. So they decided just to go with Taunton on this round. So we got locked out of this grant.
so that was very disappointing to me, having, tried to make those connections. But one thing that crossed my mind is that I might ask James Marathas, the director of the Hingham Housing Authority, how he managed to accomplish putting heat pumps into his other two housing authorities, Quincy and Marshfield. He had some kind of grant program with National Grid or something. How do you do it if you have an investor-owned utility, and see if there's some way that we can think about reproducing that with maybe, I don't know, some kind of a loan program. But that I'll see if I can find out how he did that and think about whether we could. Perhaps there are other grant possibilities. I don't know, but I was sad that didn't come through.
Okay. The next item is the design and selection procedures, or the solar canopies. So we got some pricing for the canopies. We have to get a designer to design it, and because it's over $300,000 and the designer cost is greater than $30,000, we have to go to bid for a designer. So this design and selection process says that the board can approve a body or a person to pick that designer. So I guess what I'm asking is for the board to vote to make me that person and give me the ability to, after we go to bid, pick the designer.
So moved.
Second. Any comments? If not, all in favor?
Aye.
Aye. Okay, Tom. It's all yours.
Thank you. The next is the energy efficiency, sustainability, communications. So that's the sustainability coordinator position. I do have some resumes that I have back. We've looked at them, and we're going to bring 3 individuals in to interview. Haven't reached out to them yet, so hopefully in the next couple of weeks we'll get the interviewing done and get their position hired.
Okay.
So people, I understand from Tom Mayo that right now they're really having difficulty hiring professional positions of any kind. I'm sure everybody's read about the Great Resignation, and employees are hard to find. So I'm worried we're going to lose these applicants if somebody else is going to snap them up if we wait too long. So I hope we can do that soon.
Yeah, no, I plan to do in the next 2 weeks. Is, at least reach out to them and get the interview set up. And to be honest with you, there's 3 of them. 2 of them are, from the resumes look very promising. So.
Okay, I hope we get one of them.
Yep. Next is the transmission financial model. So sorry, I'm just where I put it. So this was done by Vinnie Cameron from E&E. So I asked him to look at the financial model for the transmission system and how it would affect the rates. So Vinnie did an analysis just to cut to the chase. So one of the unknowns of the whole transmission project is the tap station that is going to be built on the right of way in Weymouth is going to be owned and operated by Eversource. Eversource is going to build that, and they'll back charge us on a monthly basis after it's built. So I don't have that estimate of what that cost is going to be. So when we do this estimate on rates, and again, as Jim talking, just listening to Jim speak today, there's some other things that we really need to look at right before we say the rates, how it's going to affect the rate. But in this analysis that Vinnie did, we were looking at a rate increase on borrowing at 2% over 20 years, well, we were looking at anywhere from, you know, at a 10% increase in the rate. Anywhere from 10% to, I'm sorry, from 8% to 12% increase in rates. But again, that, you know, right at this point, there's so many unknowns that I'm not sure that it will be that, you know. We still have analysis to do. We still have to see, you know, what the bond rate's gonna be, what the period is, how much we're gonna bond, how are we gonna use our depreciation fund? Are we gonna use it to, you know, as Jim said, pay down the interest on the bond? So we do have this analysis. We do have the spreadsheet. We can put different numbers into the equations and come up with an percentage increase. But at this point, I think it's premature.
Right. Tom, I agree with you. I don't think we know enough yet to run those numbers, but I'm encouraged by what Jim said, sort of supports what I've been thinking and what Paul and I discussed a long time ago. So,
so does this model include the application of depreciation revenue, you know, revenue that we set aside from earnings for depreciation over the next 30 years? And is that what would cause this to go to zero increase?
Yeah, that is not in this model. I could have Vinny, you know, relook at it and come up with a model that includes paying down the depreciation. I mean the interest on the bond, and see what effect that has on the rate.
yeah, Tom, I think that would be a great idea. And then once we get better numbers for a budget, we can plug those in and see the effect. But we've got a pretty incomplete model here that doesn't take into account not only what we currently have, but what we expect to add to our reserves over time.
We have to go to the DPU again and ask them for permission to get the 5% increase again next year. We'll have to do
You have
that
to do it
annual
every
payment.
year? Oh,
Yes.
Yeah, well, my sense is they'd give it to us.
uh-huh.
I wouldn't.
So if they did that over the course of the loan, then we might be able to keep rates very low.
Yeah, sure.
So this model would look a lot better if we could put that into the model. One
Right.
question that will come up for me is, well, what do we need for replacement of assets other than this project over that time? And we'll need the depreciation fund for that. So I don't have a clear picture, but that comes down to the capital plan that we're going to have someday soon. We'll understand that better when we have a
Right.
capital plan. So I really appreciate you putting this together, and it's absolutely incomplete. We don't know the answers. There are a bunch of variables that aren't in there. I agree with everybody, but I'm glad to see this work going on, and maybe you could try plugging in that reserves that we're going to set aside every year to pay that down and see what that looks like.
Right.
We are working on that capital budget, and hopefully by the next meeting, we'll have something for the capital budget for you.
Okay, great. Well, thank you very much.
Okay. What else have you got, Tom? I've got,
Developing a plan for E&E, E&E's EV program.
So-
Laurie, you asked me to put this on there.
Yeah, this is
And
something I put on the agenda. So,
So I asked,
go ahead.
I asked Mark Scribner to get on today, but he was not available, so I can get him on the next meeting if we need to have him talk to the program.
So maybe we should do that, put that on for the next meeting. I'll just summarize what my concern is. The program is going from a set like $10 a month rebate if you show the E&E that you have your car set to charge at night, which admittedly is kind of ineffective because somebody can set their car to charge at night, take a picture of it, which is what they ask you for, and then send it right back to whatever they want. It's really an honor system. It's going from that to a program where they're going to require, if you want to qualify for this rebate, to put to plug a piece of equipment into the data port in your electric car that's going to report information could report everything that car does back to a fourth party, not the consumer, not HMLP, not E&E, but a company that they have contracted with to provide this equipment. And I have deep concerns about this because, first of all, $10 a month isn't much of an incentive to anybody to do anything. And really an incentive, if it's going to mean anything, should be enough to cause people to change behavior. And that is, I don't think that's enough to do it. And I'm concerned about us being involved in a program which encourages people to plug this foreign equipment from a fourth party into their car. If I were to plug it into my Tesla, hacking into the data port of a Tesla is a famous hack point that could possibly give someone remote control over your car. And if you look at this fourth party's privacy statement, it basically says, well, we're not going to do anything terrible with your data, but we could change our privacy policy at any moment. And if you want to know if we've changed our privacy policy, just come to our website. So you have to be checking their website to make sure that they've promised not to do anything bad with your data. And to me, it raises concerns about liability for the light plant to ask for us to encourage people to plug this fourth party equipment into their car for what I see as an incentive that is not actually going to change behavior. So those are my concerns. And I would love to have the E&E guy, Mark, come in and talk to us about it. I'm not sure we should be, I'm just not sure we should be participating in this program at all.
Okay, I'll let Mark come in.
Okay. Tom, you got anything else?
The next one was the joint meeting with Hull. I know Laura asked Jake Valancourt to get on, I think. And I know I got a letter an email from Phil Lemnios from Hull regarding that they weren't ready for us to participate in this, so.
Yeah.
Yeah, so here is Jake, currently identified as iPhone. Jake is a member of the, yeah, I couldn't tell if you were here or not. Jake is a member of the Hull Light Board, and he was the one who discussed this with the Hull Light Board. I was shocked when we got the letter from Phil, who is the light plant manager and the general manager, saying he thought this was premature because I didn't think that was the summary of what the Hull Light Board had thought, but I wasn't there. So I invited Jake to tell us about it, what happened when he suggested this full light board there.
Well, good morning, everybody. My name is Jacob Valancourt. I live on 23 A Street in Hull. In Hull, we're usually supposed to say where we live before we speak about anything. Kind of an interesting policy or behavior there. So I am on the light board. I've been on the light board for a couple of years now, and I continue to advocate for sustainable and strong environmental policies and decision making. And I'm all about data-based decision making. And I brought this up with the light board multiple times. And in our most recent discussion, everyone on the board agreed that we would like to have a joint meeting with the Hingham Light Board and personnel. So I frankly don't understand Phil's response in light of the filing that we have just finished with the DPU that would be asking for, or is asking for, an investigation of National Grid and the lines that feed Hull. I think that Phil may have intended to sort of push this and many other initiatives off of the plate until certain things were done. So I'm going to ask in this month's meeting, which is a little later in November, for the same thing. And I will specifically request that we reach out to Hingham's Light Board to schedule it. So I apologize for the awkward response, but know that all of the Light Board members were in agreement that we would like to have an initial discussion. And just to prime everyone on what we're envisioning, I've asked Hull to model creating or generating more power through wind, solar, and also tidal energy, and I can explain that in a moment, than what we consume. And in that discussion, what came out of it was, well, if we're generating more power than we consume, would other municipalities be interested in a power purchase agreement, or potentially even jointly investing in this large infrastructure-based project? So that's essentially what we want to discuss. It's all preliminary because we haven't modeled everything yet, but there's a great deal of interest in Hull, not just from the Light Board, but also citizens. We have or I should say ratepayers, we have a wind turbine at the end of Hull that essentially has failed and is beyond the end of its useful life. We do have a pilot that's been funded by a federal grant, which will install a small underwater turbine near the Hull gut to demonstrate. And if they get a second round of funding, they would have enough to pay for something like a third of about a 10 megawatt underwater turbine. So 10 megawatts will be significant. And the onshore and offshore wind that Hull will consider, we could have somewhere between the neighborhood of 20 and 30 megawatts of excess energy over what our peak load is right now in Hull. So it's not massive, but it's also not insignificant. And I think it's worthy of a discussion and consideration, even before we go and model things, knowing what our immediate neighbor next door would be interested in considering can help inform a model that is not blind to the potential future cooperation of both Hingham and Hull.
Tom, and I would suggest if and when we have this meeting that we involve E&E as our consultant for power, because that would make it a little easier to maybe cut through all the issues and understand what would help us and what might be a good way for us to proceed. So I think they ought to be involved with us right from the get-go.
Yeah, I agree, Jack. I can have them.
Yeah.
So I think, as far as Hull goes, if you guys want to renew an invitation, we'll certainly try to sit down with you and talk about it.
Okay, and just to note that Hull is an MWEC client, not an E&E client, so I don't know if that raises any issues there, but I agree that it would be super helpful to have E&E with us for this discussion as our consultants on power acquisition.
Right.
If that's okay with the whole board.
Okay.
Thank you, Jake.
Yeah.
It's an hour later than I told Jake that we would get to him on the agenda, so I really appreciate your patience.
Thank you for having me. And again, sorry for the awkward response there, but we'll work to quickly recover from that.
Okay, thank you. Along those lines, though, I think maybe something that would argue for really trying to work with something with Hull, if it's financially feasible, is that the Quebec Hydro transmission line got voted down. That's a huge.
Did it? Oh, I didn't see that.
It got voted down. We're not going to have it. So a huge increment of hydropower we're not going to see. And I don't know what the state is going to do and what we're going to do. So I think everything is up in the air right now. They've made our job a hell of a lot harder.
Yeah. Well, E&E is hopefully going to make our job a hell of a lot easier by continuing to get us into these offshore wind projects that could
Yeah.
fill in the gap, hopefully.
Okay. I guess one of the there was something else I wanted to bring up and now I can't remember it. I guess, well, anyway, it'll go for another meeting. Don't worry about it.
Okay.
Okay. Just to go back, 'cause I missed one, developing a plan for net zero. So we did have a conversation with E&E on this. And we are doing a hosting study to see how much solar we can host on each of the circuits. So that study will start sometime probably next month. LIG is going to do that study for us.
I'm sorry,
As far as-
LIG? Is that a?
Yeah, that's
Who are they?
that's our electrical engineering consultant,
Uh-huh.
Tom Condress. He's working on the transmission project also.
Oh, okay. Thanks.
I did have a conversation with E&E on this, and at the end of that conversation, one of the things that we really need to know is how fast do we want to get to net zero? What's is it to meet, to be in line with the state? Is it how fast? What are we looking for? Because we really can't develop a plan until we have that, and then I guess for me here in the light plant, that also means electric vehicles, electric trucks, converting this building to electric from gas.
Mhm.
So I guess that we need to look at what are we looking for timeframes.
Is it possible to compare timeframes? What if we tried to do this by 2030? What if we tried to do it by 2040? What if we tried to do it by 2050?
Yeah, I mean, I guess one thing I could do is I could have E&E come in and talk about, what's available for renewable power right now, and how does it look, how does it work into our portfolio, and, with the other things that we have long-term contracts on already, as a starting point.
That would be a great start, I think.
All right,
And
why don't I see
do you
if-
think that would help us set a time to plan to?
Yeah, it might help the board, look at kind of the time frame. I think,
Okay.
to formulate something, help us formulate, the time frame, and then we can work from there.
Is that a good idea, Jack? Have
Yeah,
E&E
no,
come in and,
I think that is, one of the things we got to define what net zero is for the light department. Is it our
Yep.
power mix? Is it our trucks? I mean,
Yeah.
that's a tiny amount compared to the power. So it might be that we should treat them both separately and work on power first. And then as sort of an operating philosophy, try to figure out how to convert our other activities to batteries, which is kind of what it is.
yeah, I agree. The light plant's mission that you adopted last year references sustainable operations, but when you compare our operations versus the power supply, one of these is not like the other, and one is larger and more important. It feels like the decisions around moving to net zero in operations is just an ongoing decision where you come to a decision point and go, okay, this truck is retiring, what truck shall we buy, and so forth. It's just something that we do ongoing as time goes on.
Right. Okay. All right. Have we got anything else? Is that I think that sort of,
Just a couple of, I'll try to make this quick. In the package I sent to you, there's an open meeting law training and there's a summary of conflict of interest law for municipal employees. There's an annual acknowledgement there that we're supposed to fill out. I have all the employees here, have filled it out. I just need to get that from, I guess, Jack, I know you sent me the annual open meeting law.
yeah, I'll get the other one out to you.
Yeah, and then I need both of those from you, Laura. I know you went to the training, the open meeting law training.
Yeah, I sent my open meeting law certification to the town clerk because that's what they said to do at the meeting, but I'll send it to you too.
Oh, okay. That's all right. I can get a copy from the town clerk and just keep it here.
Well, it'll be easier for
And-
me to send it to you so that you don't have to do that. I'll do that.
And then on the conflict of interest, there's an online training that is supposed to be done every 2 years. I know I had everyone here do it. If I'm just asking if you can both do that.
Okay,
I'll do. And that's at the Secretary of State's office, right? The Secretary of State?
Yes, yep.
Email, website.
I can forward the link to you.
That
Yeah,
would be-
Link.
Make life simple.
that would be helpful, Tom. Thank you.
Yeah, okay. Financials. So, for the month of August, our kilowatt hours sold, 18 million, revenue of 3 million, expenses 2.7, so net income of 231,000. If you look at, compare that to 2020, net income was down significantly. When I looked at that, our August revenues were down by $600,000. Our sales were down by 4 million kilowatt hours. So obviously, August was a cooler month, and our power supply expenses were up by 250,000, which explains the net income of 231,000.
Mhm.
When I looked at budget-wise, we're still on budget to be 4.2% return. And year-to-date, our revenues are up by 5%, and our power supply expenses are in line, and our other expenses are up by 1%.
So this is basically a blip related to things happening
It's
this
a
month
blip,
that
yeah.
won't happen next month.
I was looking at the September numbers. I don't have them yet, but I think that revenue in September was about 700,000. So not sure how they compare to what we had budgeted, but
Okay.
Okay.
the battery storage has been working. I'm still working with Kruger on some contractual items as far as the battery, the secondary use, which is the regulation market goes. And we have some issues to work out as far as the liquidated damages go. We're still working on that. I have a meeting with them this afternoon. The transmission line, we have a meeting with another community meeting on 11/18. We're going to put together that presentation now. It'll be similar to the one that we did in the beginning of October. The landfill solar, it looks like that is going to be sometime in the spring to start. They've ordered some of the materials, but like everything else, that won't be in until springtime. EV charges, I'm still waiting on the state. I haven't had any response back from the state on whether we got those grants. The Choice Connect system, most of that is up and running. We are utilizing it, not fully yet, but we are playing with it. And the rest of that material is due in, it was supposed to be in this month. It's not going to be in until January now. And then the municipal solar, Laura and I spoke about this yesterday. The town's working on the RFP for the consultant, and hopefully we'll have something on that
We wrote a scope of work which Tom Mayo reviewed and Steve Girardi gave some ideas on yesterday. I'm going to rewrite it with those in mind. And then the next task, once we're all agreed on that, the next task will be to get the town and the schools to make a list of the facilities that they want to be reviewed. And that could take as long as putting the scope of work together did, because it's hard to focus their attention, but I will get to work on that.
And that's all I have.
Okay, does anybody got any quick comments about our proceedings today? Guess not. So do we have a motion to adjourn?
So moved.
Second? All in favor?
Aye.
Aye. Thank
Thank
you,
you.
everybody.
Thank you.
Thank you. Have a good day.
All right.